So we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We resume our coverage of the summer of strikes, and specifically strikes affecting our supply chains. Two strikes in particular, one averted over at UPS and one not averted over at the trucking company Yellow. Joining us right now to talk a little bit more about this is Jason Miller, professor of supply chain management at Michigan State University's Broad College of Business. And Jason, let's start off here with Yellow here, because I know a lot of people are trying to make this connection between the Teamsters voting to strike there and this company sort of going under. But there were a lot of other issues there, and I am curious that when you have a trucker like this shut down, how much of a ripple effect does that have on our supply chain on getting things from point A to point B?
Yeah, so starting with that last question of the ripple effect, right now fairly minimal, and that's because the less than truckload sector, which is where Yellow is, so moving 1 and 2 pallets at a time, has seen a substantial decrease in activity. Volume is down about 10 to 15% from the highs that we saw in 2021. And so Yellow represents about 10% of overall demand. And when you have 10 to 15% demand being down from the peaks, it somewhat washes out on aggregate.
Is there a sense, though, I mean, when we talk about a trucker like this shutting down, also there are other labor issues bubbling at other places as well here. Is there something to be concerned about? Because we came out of this pandemic thinking that maybe we finally sort of dealt with some of those supply chain issues that were the outgrowth of the pandemic, and now we're dealing with a separate set of issues that may persist for some time.
Yeah, so I think on the labor side right now, given the inflation that we've all experienced, you were seeing unions in a negotiating position where it's a tight labor market. There's been a lot of inflation. They're demanding substantially more. That's what we saw in the case of UPS. But then this is also interacting with freight recessions in the parcel sector, a freight recession in the less than truckload sector. And so let's say in UPS's case, that made management more willing to deal with the union and essentially give in to the demands, because the estimates that we've seen from Ship Matrix were that UPS lost about 5% of their parcels to FedEx over the past month.
Well, Jason, against that backdrop, where does that leave the 30,000 employees that stand to lose their jobs here with Yellow shutting down? How easy will it be to basically find another job?
It'll be substantially more difficult now because we're now essentially entering year 2 of a freight recession for the overall trucking sector. You can see that being expressed in the quarterly reports of the big players who've come out over the past couple weeks. I do expect that we'll see some of the other less than truckload players will move to acquire some of Yellow's assets, and especially their best drivers. But it will be challenging because right now we have excess capacity in trucking overall.
Excess capacity, we're already starting to see that shakeout. Does that mean there's going to be less leverage for any employees remaining at these other companies, wherever they move on, to demand, if not better pay, better working conditions?
Yeah, so especially in trucking, there's only now 2 major unionized firms left, T-Force Freight, which used to be UPS Freight, and then Arkansas Best, or ABF. And so those 2 organizations just had new 5-year contracts signed over the last month and a half. So right now we're kind of at sort of a smooth, steady state from that unionization perspective.
All right, Jason, going to have to leave it there. Great to catch up with you. We should talk again. Jason Miller, professor of supply chain management over at Michigan State University's College of Business. Coming up here, we're going to round up the final curve here into the final hour of trading as we count you down to
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And good afternoon, everyone. Live from the Bloomberg Interactive Brokers studios, streaming on YouTube and on Bloomberg Originals. Happy Tuesday, first day of August, 2023. I'm Tim Stenivek, along with my co-host, Madison Mills. Carol Masser, he's off today and for the rest of this week. Maddie, equity's mixed on this afternoon here, but you know what? It's a little bit of a down day on the S&P 500, on the NASDAQ, up day on the Dow Jones Industrial Average. The rally that pushed the stock market closer to an all-time high, losing a bit of steam. Traders are wading through a mixed batch of corporate earnings. We got more after the bell, too. And some economic figures. We're going to have a deep dive on the markets and the economy in just a minute.
Yeah, it's an interesting day because it seems like the months and months of winning when it comes to the market, specifically the S&P, are starting to finally tame down a little bit, particularly off of some of that mixed economics data. So we're going to have to talk with our eco guests on that as well. But a great story, Tim, that I know you're going to be excited about that we're talking about today.
I love anything about California.
Cali.
Yeah, so you may have heard that people are fleeing California. Well, you know, some are. The state has lost about 500,000 people over the last 3 years. But the wealthy who have stayed put, they are flourishing. We're going to dive into that with Biz Carson a little later in the program.
Good for them. I love that for them. Good for the wealthy. Also, a story that you're definitely going to be leading when it comes to our interview is about Apollo Global Management, some of the leadership getting shaken up a little bit.
Yeah, is there a kinder, more gentle Apollo Global Management? We're going to take a look at what Mark Rowan is doing more than 2 years after Leon Black and his partner Josh Harris departed the private equity firm, although now it wants to be more referred to as alternative asset manager and not be known for private equity. So we're going to dive into that one as well. What else do we have, Maddie?
A little rebranding, right?
Yeah.
A little rebrand.
Maddie, have you heard about the overflowing garbage heaps and septic tanks in Miami? Are you from, where are you? You're from Florida.
I'm from Florida. I'm not from the area with the overflow of septic tanks, unfortunately, because that would have given us great color for this
We could have sent you down there to,
story.
give you a microphone.
Put me in the field. I mean, I'm ready.
I'm
I'm ready. Yeah, but this is interesting because also we have to remember the mayor of Miami running for president. And his town is overflowing with garbage.
That is a very good point. That is a very good
Those
point.
are just two facts that happen to be true at the same time.
And a little more economic news later in the program from the magazine. The architect of the Somme rule, Claudia Somme, she's worried that her creation has become a, quote, monster. We're going to check in with the team at Business Week a little later in the program. All of this and more to come. First up, let's bring in our TV colleagues as Bloomberg's countdown to the close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld, joined now by our colleagues Tim Stenivek and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership for those folks at home streaming on YouTube. Tim, a lot of discussion today here about the greatest state in the country. And I'm told, at least by my producer in my ear,
I'm so glad
that it's not New York.
It's not. I'm so glad you said
It's not Illinois.
It's
New
California.
Jersey.
It's not New Jersey.
It's not New Jersey. I knew that was coming, Katie.
Yeah.
It's the great state of California. You know, over the last
how's
few
California
years,
going? I thought California was like sliding into the ocean.
Yeah, right?
It always is.
Okay.
As a Californian, I can say this. It's always like, burning or, flooding. But I will tell you that despite what you may have heard over the last few years, and yes, some people are fleeing California, it turns out the ultra wealthy are doing quite well there.
We love them,
Yeah, they're not all leaving to go to Miami.
We love the ultra wealthy.
Or going to Texas or going to Arizona.
That's our audience.
I know.
They've minted more billionaires there than anywhere in the world.
In California?
For China, yeah.
Wow.
Thanks to a little AI rally that we've seen over the last few months. That's helped.
Well, and it's not just the billionaires, Tim. It's also the millionaires.
They're doing okay, too?
They're doing okay as well. They are also staying in California. And as you mentioned, fifth biggest economy in the world. We're not necessarily seeing people leave despite some of the challenges that you mentioned, Tim. Those wildfires, housing costs, people sticking around.
Yeah, and there's been so much talk about this, even when you had some of the high-profile companies that said they're going to go to Texas or Florida because they got incentives to go there and lower taxes. But at the end of the day, I mean, there is an economy there in California that, at least right now, from what I understand, hasn't really been dented.
Yeah, well, enjoy it while it lasts. So that's radio's top story.
New Jersey.
Are people moving?
Everyone's going to New Jersey or something?
Everyone's
What's going
moving
on
to
here?
New Jersey.
Still going to Austin, right? Isn't that
Yeah.
what's happening?
Austin's supposed to be cool and young. I haven't been there. In any case, let's talk about hedge funds because there is an AI angle here as well. Really interesting survey out from BNP saying that 44% of money managers use artificial intelligence tools in a professional capacity. We're talking about marketing to summarize vast reports, maybe actually produce broker research reports. So we'll see what that means for that class of analysts who's writing those strategy notes that we all read.
Yeah, and it's not too surprising. I mean, as we know, a lot of this AI hype is just kind of the same technology that's existed for a while, just kind of rebranded and repackaged. And so we know that a lot of these firms have used automated, if you will, tools to do basic tasks. Whether they do more complicated tasks remains to be seen.
Yeah, and I think the key too is how do you use it to actually get an edge on another firm? I mean, Katie, you wrote that story a few months ago that that had ChatGPT trying to pick stocks.
Yeah.
And it didn't actually succeed, right?
Didn't do too well. I think
Yes.
the question when it comes to the world of investing, is this going to be used to produce better returns, or is this basically to do busy work, to take care of the grunt work and free up the people making the decisions to have more time to make those decisions?
Or reduce a little headcount?
Maybe.
Increase those margins.
reduce a little headcount. But you know what's interesting, guys, from our M Live this week, we talked to our audience of respondents there, and they said that they're still bullish on these AI stocks leading the Magnificent Seven that we talk about all the time, but they don't want to pay up for AI tools. And that feels like the fundamental question, right? We're still bullish on these AI stocks, but if those same investors aren't willing to pay for AI tools, where are we going to see the profits coming in?
Yeah, that's sort of been the kicker in all this. I mean, there's a lot of investment in this right now, but not necessarily a lot of return.
Yep.
Love the yellow, by the way, Maddie.
Thanks, Romaine.
What about the blue?
Katie, yeah, you look great too.
All right.
You're in blue as well.
Everyone
looks great.
That's totally sincere.
All right,
Bye,
sit
Tim.
tight. Everybody sit tight. Don't worry.
Tim,
We're gonna be
your
back
collar
here.
is a little out there. You need to kind of,
Leave him alone.
We don't get to
This is
see
why-
ourselves. We don't
this
have
is
a
why-
monitor in here.
This
so
is
we
why
never
I love you, Romaine. Thank you for doing that. All right, we're back together live on TV, on radio, and on YouTube. Bloomberg Originals as well. A little less than an hour. 4 p.m. for our Beyond the Bell coverage when we take you through today's market close. We've seen over the last few months. Taking a little bit of a breather today. The Dow's higher, but the S&P and the NASDAQ are lower. Traders are wading through a mixed batch of corporate earnings, economic figures. We got jobs report coming later this week as well. Got a great duo to dive into this right now. It's Elena Shulyatseva, senior U.S. economist at BNP Paribas, and Alexandra Semenova, Bloomberg equities reporter, talking everything with last week in the Fed, what's going on with the pause and the rally, and of course, what to expect when it comes to the jobs report this week. Alexandra, I want to start with you and just get an idea of what you're taking a look at, especially given that we're at 19.3% year to date for an increase on the S&P 500, and the NASDAQ has gained more than a third.
Yeah, sure. So obviously it's been quite a lackluster start to the week, but it's not unusual after the incredible run that we've had in equities for investors to take a step back and take a breather and maybe do some profit taking, especially when we have such a big week ahead with Apple and Amazon reporting results. We also have the all-important jobs report at the end of this week that will give investors a better sense of whether or not we'll get another interest rate hike later this year in the fall, or whether, the one that we just saw from the Fed is the last one. That, of course, will really determine whether this rally has staying power or not, because everyone's looking ahead to this soft landing that has fueled optimism in stocks in recent months. And whether the Fed can engineer it or not will depend on whether they found that sweet spot with the rate hikes, whether the economy keeps, carrying along, whether consumers keep spending, whether the labor market stays as strong as it's been. So that's what investors are really watching.
I love that you brought up the labor market, Alex, because that's exactly where I want to go with Yelena. And thank you so much for joining us this afternoon, Yelena. I'm curious how you are kind of digesting these U.S. jobs numbers that we got this morning, falling in June to the lowest level since April 2021. The number of available positions also easing. When you look at the totality of that data, as Jay Powell would say, where do you suss out the takeaway when it comes to where our jobs market is at?
Well, the JOLTS data this morning clearly hinted at a gradual cooling in the labor market. This is kind of what the Fed would love to see, and this is exactly what the data are giving us. So, yes, we saw a modest decline in hiring rate, in quits, but the labor market cooling is happening only gradually. So, in other words, demand for workers still exceeds supply. And if you look at the ratio of openings to unemployed, it's still kind of at the same 1.6 level that it was in the previous month, and we only see a gradual cooling in that metric. This is one of the Chair Powell's favorites, obviously.
I think a lot of people, Alex, were caught flat-footed at this rally. Yeah. Especially a lot of Wall Street strategists who you follow really closely. I made this kind of joke yesterday that, Mike Wilson, it's like, I leave for a few months for parental leave and I come back and Mike Wilson's a bull.
Yeah.
He's not quite a bull yet, but he's like, coming out with these notes saying that he missed it. But it's not just him.
Yeah.
We got others coming out today. What's going on?
It is incredibly significant to hear Mike Wilson kind of change his tune on the rally because he has been one of the staunchest bears on Wall Street. He, of course, correctly was one of the few strategists last year who did see the rout in equities coming and has maintained that view going into this year. But last week in his note, he admitted that he was wrong, that he was pessimistic for far too long. And then in his latest note this Monday, he says that this rally is kind of looking like 2019 when the Fed cut rates and stocks were trading on multiples rather than earnings. And of course, as we remember that year, the S&P 500 returned 29% to investors after a down year. So he said that his own analogy implies more upside ahead for the S&P 500. That is such a huge
Doesn't he have a 3,900 price target on the S&P?
Exactly. So he has maintained that price target. He's been digging in his heels this whole time. He's been calling for an earnings recession, making this argument that we haven't yet seen the worst of corporate margins, but now totally striking a different tone there.
Well, Yelena, I'm curious, too, when you think about what Alex just said, an earnings recession, do you think that the Fed needs to start looking a little bit more closely at the information that we're getting from these earnings reports?
Well, the Fed is looking at the totality of data, including those earnings, of course. But in our view, I think the Fed, the July FOMC meeting really marked the quiet arrival of the terminal rate of the cycle. I think the Fed will be satisfied enough with where inflation is heading, and we think that we will continue to receive somewhat softer inflation prints in the next couple of months. So the Fed will just pause in September. Or as we like to call it, they will skip September. And if they decide to, that they haven't made enough progress, they may, entertain a possibility of the November rate hike. But
wait, hold on, Yelena. There's a long time between now and September. We got an employment report. Next week, we got another inflation report. Actually, this week, on Friday, we get those jobs numbers. Got another one before September's Fed meeting. We got Jackson Hole before the Fed September meeting. So, a lot can happen, right?
Totally. There's a lot that could happen even before the Jackson Hole meeting and before the FOMC meeting in September. But I think the data are trending in such a way that will allow the Fed to skip the September meeting. So Chair Powell left options open for the September meeting, obviously, but the latest inflation print and what we expect to see on the jobs, on the labor market front, makes us believe that they could actually skip the September meeting. And if things reaccelerate in the fourth quarter, they could always hike another time in November. But we clearly, we really doubt that will happen with all the headwinds in terms of a possible shutdown, student loan repayment resumption. Those headwinds will start to be like more visible going into the year end.
How does that square then, Alex, with what your sources are telling you about what's going to be driving the trade as we head into August?
I mean, I want to echo what Yelena just said. The immediate reaction in the aftermath of the last FOMC meeting and my inbox from all the macro folks was, this was the last hike. It was a pretty confident the Fed is done. And that has much to do with, as Yelena said, the positive trend that we've seen in inflation, the Fed not wanting to overdo it. And that's really when we saw this flurry of strategists come in and change their targets. Take a look at Scott Cronert over at Citigroup, for example. Yesterday, he upwardly revised where he sees the S&P 500 ending the year to 4,600 from 4,000 previously. Just 1 month ago, he said that we do not see enough fundamental reason at this point to change our target, as enticing as it is to follow the tape. So just several weeks have passed, and he struck such a different tone, saying that soft landing optimism is going to drive stocks higher.
Alex, isn't there a contrarian indicator in here when everybody starts to get bullish?
There is indeed. So Bank of America today released its sell-side indicator report, which it puts out monthly, and it said that investors Wall Street sell-side strategists upped their equity allocations by the most since 2021 last month. Typically, that is a concerning sign. Everyone's piling into stocks. Usually when Wall Street strategists are super bullish, that's kind of a bearish sign for what's ahead for the S&P 500. But they said, don't worry just yet. We're actually still in neutral territory, and it's still closer to a buy than a sell signal. But we are seeing this chasing of the rally among sell-side strategists who for so long sat out of these gains, missed out on this incredible run that we've seen in stocks.
And I keep wondering what the fuel is going to be for more rallying. Yelena, in our final kind of 30 seconds with you, we've got a big week of eco data ahead here. What do you think is the single biggest data point that we need to watch if we are to anticipate the Fed's next moves?
Payrolls report, of course, and we are 225 on payrolls and a tick down in the unemployment rate. But the key here is to look at the details, watch private sector hiring. That has decelerated quite significantly in the last couple of months, so we would like to see what happens next, whether it continues whether this deceleration continues.
Yelena, what was the number that you have over at BNP? For change in non-farm? 225?
225.
Okay. I'm just looking at the Bloomberg terminal. The consensus right now from the survey of economists is 200,000 right now. And of course, that comes after 209,000 last month. A big thank you to both of you, Elena Shaleitova, Senior U.S. Economist at BNP Paribas, and Alex Semenova, Bloomberg Equities Reporters. Really appreciate you joining us. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We're looking at a mixed market with just about 39 minutes to go ahead of the closing bell. The Dow higher. Right now we have got the S&P, NASDAQ. They are both trading lower. A 64-point gain for the Dow, up now by about 0.2%. S&P holding close to a 16-month high. We've got the S&P lower by 8 points now, down by about 0.2%. The NASDAQ Composite Index down 43 points for NASDAQ, a drop right now of about 0.3%. 10-year yield 4.04%, with that 2-year at 4.90%. Spot gold down $19.50 the ounce to $19.45, a drop there of 1%, while West Texas Intermediate crude is down 0.4%, 81.42 for a barrel of WTI. Airline stocks are lower, in specific JetBlue. JetBlue Airways down 8.2% after slashing its full-year profit forecast and said it would earn less than analysts expected this quarter because of a larger than expected shift away from domestic flying in favor of international routes and the termination of that operating alliance with American Airlines. Well, as for the overall outlook for the airline industry, the broader picture, Helene Becker covers the airline industry for Cowen.
We are seeing very good demand on the North Atlantic, especially, and we're seeing less good demand in the U.S. domestic market. And what we have been thinking is that 2021 and 2022 were all about U.S. domestic because there really wasn't a lot of places to go internationally. And now that the international markets are open again, people are traveling again.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Again, JetBlue shares down 8% among some of the other carriers. United Airlines Holdings down 2.1%. American Airlines Group down 3.1%. Delta down 2%. And Southwest lower now by 2.2%. Recapping, stocks are mixed. The Dow higher. S&P down 9, a drop there of 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie, you'll use any excuse to talk about airlines.
Yeah, but think of me as the Matt Miller of the airline world, as opposed to Matt loves cars, I love airplanes.
Well, the difference is Matt gets to drive the cars. You don't get to fly the planes.
No, but I get to travel back in coach in the worst seats possible.
Right,
but that's another conversation for another time.
You got to get your license, Charlie.
Exactly.
All right, thanks so much, Charlie Pellet. Well, for the past 3 years, something has happened in my home state of California that has never happened before. It's lost population. More than 500,000 residents have fled, relocating to cheaper locales like Texas and Arizona. But despite what you may have heard from some high-profile venture capitalists, it's not the wealthy who are leaving. It's not the wealthy who are struggling. In fact, the wealthy are doing really well. They're flourishing in California. This year through July, California's billionaires added $270 billion in wealth. That's according to the Bloomberg Billionaires Index. It tracks more billionaires in the state than in any country except for China. Biz Carson is Bloomberg News wealth reporter. She wrote that story. She joins us this afternoon from San Francisco, from our bureau in San Francisco. Biz, good to have you with us. You've lived in California for a while, haven't you?
Yeah, it's 10 years now in California, so that's quite some time.
So how is the narrative where you've been in Silicon Valley? How has it shifted, and what made you want to explore this story?
Well, I think there's been a big shift in California. I don't think you can deny, there has been a historic population loss in the state. But the last 10 years have been a huge time of wealth generation, particularly in Silicon Valley. You've seen it in Hollywood. The state is richer than ever. And so when we got our hands on some tax data from the state of California, we realized it was something new to me, just the record number of millionaires that had been created over the pandemic time period. And it's a wealth creation that we haven't seen before in the state.
And I wonder, too, why we're not seeing more of the Ken Griffin movement, I guess. Why aren't we seeing some of the wealthiest people say, I don't want to pay the taxes to be here anymore?
We've seen a few people, like Elon Musk and Larry Ellison, I think are the two biggest names to say we're leaving. But a lot of people are staying, but it's not necessarily something that they're bragging about, like, oh, I love paying my higher taxes. I'm so excited to stay in California these days. Like, it's just not part of the conversation. It's more part of the conversation when you're looking at the weather and it's beautiful 70 degrees compared to the rest of the country.
Hey, way to rub it in.
Yeah, I know.
It's always like that. It's beautiful.
I had to wear I'd wear a jacket today. It was very cold. And so you're not seeing kind of this, you're seeing it from a handful of people who are beating the drum saying California's time to go. But the people who are staying here, the people who are getting even richer, don't have as loud of a voice. And I think that was kind of the counter narrative we found in this data, is to say, wait, there's more millionaires here than ever, even if you think that everyone's up and left.
It's wild, this data that you got your hands on, Biz. I'm going to read right from your story, okay? In total, more than 288,000 Californians, or 0.7% of residents, so that's close to 1% of residents, reported over $1 million in income in 2021. So you almost have 1 in every 100 people in 2021 getting $1 million in income. The thing that's
that's income.
That's
it's
income.
Not just, I own a house that's worth $1 million. We're talking income that they're reporting on their taxes. And the caveat is that
what's the caveat here?
Yeah, it's typically where we think it's an underestimation of the millionaires, because a lot of people, when they get to a certain level of wealth, they're reducing their personal income tax burden and shifting around, taking out debt, other things. So we think it's likely higher, but this is the bare minimum of what we know who's reporting $1 million or more in income.
The flip side of this, though, is the affordability crisis in California. And what you do note in your story is that the people who have left have left for places that are less expensive because they found affordability challenging in California. It's really hard to afford a house there. There are no starter homes in California. What's going on?
Absolutely. I think these go hand in hand, right? We saw this record number of millionaires being created, but California also became a more unequal state. It moved up in the Gini coefficient, which is a measure of inequality in the state. And so we've seen the state become more unequal, partially as a result of this wealth. And only 1 in 5 people in California right now can afford the median home price of $800,000. So you can't, this data shows an exorbitant amount of wealth, but with that, you are creating inequality. It does become harder to live here. The rich can buy up the houses, leaving everyone else struggling. And we see that now playing out in some of these labor strikes in Hollywood. Fast forwarding to 2023, labor is a huge issue. Inflation's been hard. So this wealth is true. It's created a ton, but it kind of exacerbates the problems in the state as well.
That's really interesting, because that makes me wonder whether that is going to be the headwind for California, or if it's going to be something else. What do you think is the single biggest thing that could change this dynamic that we're seeing of the ultra wealthy continuing to stay there?
That's a great question. It's not necessarily taxes. That was something that was surprising to us, and as we reported this story, taxing the rich doesn't necessarily have any effect in California specifically on them moving out of the state. So we can't just say, well, we'll tax them and decrease their wealth and everything will be fixed. That's not going to happen. What could fix California? That is a question way above my pay grade, and I have no idea. It's a challenging state. There's a lot of people here, a lot of economic inequality, and we'll see, what kind of the pressure of these labor strikes, how the government responds, things like that what that will do to the state. So that's kind of an open question.
Yeah. I'm wondering too about the politics there, and this isn't a politics story per se, but everything is political, as they say. So I wonder to what extent these wealthy people are controlling or trying to control the politics in the state. We saw some high-profile recalls in San Francisco. We've seen a mayoral race that's backed by some very wealthy people in the city. What can you tell us about their role in politics?
I think the wealthy have always had an outsized role in politics just due to be able to bankrolling it. That's not unique to California necessarily. I think, given we have more wealth in the state, will we see something happening in the election coming up? I don't know. I think that's going to be an interesting question. Will this shift any part of the voter base? I don't know. The one interesting part of this data is California's reliance on personal income tax and this 1% bracket. Because of the tax system, it relies on the top 1% of earners, roughly 50% of the personal income tax revenue. So anything that does happen to the incomes of these top earners has real effects on the state's budget. And so I think that is kind of almost a bigger political question of if these top earners start losing money, if the economy swings in a bad direction, that's going to have bigger political ramifications, I think, for the state than necessarily, wealthy millionaires donating to local political campaigns.
Biz, I want to end with your lead on this story. It sets the scene with a party for the core club. It's members-only club. It opens next year for Californians who are ready to shell out $15,000 to $100,000 in initiation fees. Just describe to me the vibe there or in Silicon Valley right now at a time when, people have said that California and Silicon Valley just feel different.
They do feel different, but there's still, it's still some great times here. The AI boom is centered in California right now. This party happened at the Transamerica Pyramid, which is undergoing this $1 billion renovation, and a New York developer bought the building and is renovating it, and it's going to be this big $1 billion project. So there's still investment, there's still excitement in California, but it's been tempered a little bit. I think the last few years have been hard, particularly in the San Francisco downtown. We've seen it with office spaces, so there's a bit of a vibe shift, but people are still, able to sip cocktails and champagne and pass appetizers on the 36th floor and be happy with their lives.
Does it still seem like
more?
Does it still seem like San Francisco is as empty as it was during the pandemic, or are people actually going back to work? They're taking the shuttles south?
The downtown core, I'd say, is still somewhat empty, when you're talking Union Square, Civic Center, but the neighborhoods are flourishing. I took the F train today down Market Street to the Bloomberg office, and it was packed with people and tourists. So there is a liveliness to the city. It's just not quite the same energy of, all the tech workers with their matching backpacks, flooding Montgomery Street. That has gone. The lines for lunch are a little shorter than they used to be. So I may not complain about that. But, there is a bit of a vibe shift.
Biz, Carson, it is good to have you on the program today. And, I got to say, Maddie, I may be biased here, but I'm certainly rooting for California. And, of course, every state here in the U.S. But California is a special place.
We're not biased.
In my heart. We're not biased.
We have no opinions or thoughts on states.
Biz Carson is Bloomberg News wealth reporter joining us from our San Francisco bureau. Thanks so much, Biz. Appreciate it.
All right, we're going to switch gears a little bit because we have a great guest with us in studio here. I don't know if you've been on Overstock.com today, Tim, but if you load that in, you're going to get redirected to the Bed Bath & Beyond website because Overstock.com is now operating as Bed Bath & Beyond in the U.S. following the rebrand in Canada, and we are joined by the CEO, Jonathan Johnson, in studio. Jonathan, thank you so much for coming in today. I am currently shopping for some mid-century modern products on the website here, but also previously while I was working, I did a video on Bed Bath & Beyond, and the title was Bed Bath and Bankruptcy. How are you planning to leverage the assets and IP that you spent a little under $22 million on to leverage the brand without that same ending?
Yeah, that's a great question. We've long liked and looked at Bed Bath & Beyond as a brand and as a loyal customer base. We understand its business fell on hard times. Our view is that management can kill companies, but not necessarily brands. And before we purchased the brand, we did some consumer research, and we saw that in the home space, Bed Bath & Beyond was still a top 5 brand, well-known, well-trusted, and associated with home. Overstock, on the other hand, has a business model that really works, but a brand that was actually creating some headwind. We started 2.5 decades ago as a liquidator, but it's been 20 years since we were a liquidator. And a lot of our customers still were not, and potential customers still were not associating us with home products, home furniture. Sure. They were associating us with liquidation. So we thought, why don't we take our great business model and this great consumer, iconic consumer brand that is Bed Bath & Beyond, put them together, and it allows us to really rebrand in a way that's a lot less expensive, a lot less time-consuming, hasn't really been done before. And when we did it, started last month in Canada to test it, it really resonated well.
So what's the impact on revenue?
Well, hard to know just yet. We've been kind of quiet about the impact on revenue in Canada. but it was significant.
What is significant?
I'm going to be
ballpark?
I'm going to be very careful not to talk. We had our investor call last week. We didn't talk about it, but something significant enough that we wanted to rush and do this rebrand as soon as possible in the U.S. The going out of business brick and mortar stores just closed this weekend, and we're up and running today. I think that tells you that it's meaningful for us.
So I'm curious about the experience that people have shopping at the new Bed Bath & Beyond versus the old Bed Bath & Beyond and versus at Overstock. Is the experience that you're going to get when you visit Overstock's website now goes to Bed Bath & Beyond? Is that a Bed Bath & Beyond experience or is it an Overstock experience?
I think it's a mix. And by the way, those customer sets have a lot of overlap in their behavioral demographic. Today when you go to that site, it's gone from red, the Overstock customer color, to blue, the Bed Bath & Beyond color. The Overstock logo is still there today.
I see it. It's the Rewards Club logo.
And it's the Rewards Club logo. We will sunset that over time. We just want our legacy Overstock customer to feel comfortable. The taxonomy and the search will feel very familiar to the Overstock customer. There's a little bit more promotion and prominence to bed, bath, and kitchen products.
Sure.
So that the Bed Bath & Beyond legacy customer feels comfortable there. But it will really feel like both for a time, but morphing to Bed Bath because that's who we want to become.
You've also got the classic tried and true Bed Bath & Beyond coupon offerings advertised at the top of the page. That is part of what people thought was a potential downfall for Bed Bath & Beyond. So how are you thinking about some of the things that made Bed Bath & Beyond so well known, but also were a little bit of a tailwind, or headwind rather, for them?
So we are a promotion. We've always been a promotional company with site sales, with coupons. As we do this rebrand launch, the coupons are big. They're Bed Bath & Beyond-esque size.
Yeah.
Over time, they won't be that big always because our prices have been sharper. But for that Bed Bath & Beyond customer who has loved the coupon, what they really will love is the new Bed Bath & Beyond mobile app. If you download that today, there's a nice coupon there. We will continue to push promotions that way. That's been a hugely successful thing for Overstock, and we want it to be that way for the new Bed Bath & Beyond.
Bricks and mortar strategy. Is there one?
Yeah, there is, and it's not to have it. We never say never.
Okay.
We'll continue to look at it, but we like our asset-light business model. We think part of what brought the prior Bed Bath & Beyond down was lots of leases, lots of inventory, moving away from name brand product to private label. We like our business model, asset light, name brand. So we never say never, but we say never for now, if that oxymoron makes sense.
That makes sense, but I do wonder because some of the products are so big, some of the products people would argue need to be tried. How do you get the consumer past that?
So I think Overstock has done really well at that. And so for the typical bed and bath product, linens, small appliances, kitchenware, that seems like it will fit really well. What Overstock has historically been good at is area rugs, sofas, patio furniture.
This is the Beyond part of the Bed Bath & Beyond.
Yeah, it is the Beyond.
Bed Bath & Beyond were good at the bed and the bath.
And I would say
Overstock was the Beyond.
And I would say it's a much bigger, better Beyond now. The number of product that are available on the new Bed Bath & Beyond site is much bigger, and it's a lot of Beyond. And so we think we've done well at that, even with the headwind of kind of this Overstock brand that didn't fit who we were. We think with Bed Bath & Beyond, that headwind turns into a tailwind.
So, as you know, revenue at Overstock and formerly Bed Bath & Beyond had been falling year over year. I know you won't give a specific, but what inning would you say we're in when it comes to reversing that?
Well, I think the economy has been particularly tough for our industry. The pandemic was a huge tailwind and everyone got that pandemic bounce. And then I think while the country may have avoided a recession, I think our industry did not. Furnishing and home furnishings have been in a recession. I think that's normalizing now to seasonal trends, but it's not back to normal as far as what people are spending their money on. It's still very much experiential. It's going to the Taylor Swift concert.
Right.
It's doing those kind of things. That will come back, and I think our playing offense during this slower time in our industry cycle, when the cycle comes back, we'll be able to slingshot out bigger and stronger.
How would you feel if you became a meme stock, a la Bed Bath & Beyond?
We don't want to be a meme stock. We want to perform based on we want to be rewarded based on performance. So when it's time to change our ticker, I can tell you one ticker we won't use, and that's BBBY, because we don't want to go back to that place.
Yeah.
How's the consumer right now?
The consumer is out there. They're looking for deals. And so, for example, around 4th of July, we had a great 4th of July. We had a great Memorial Day. We expect to have a great Labor Day because it's big promotions that are going on. The consumer has money to spend, but they want to be careful and make sure they're getting a great deal.
Do you think there's going to be a recession?
Boy, I'm hopeful there's not, particularly since I think this industry has been in its mini recession as it is.
Right.
By the way, I think some of the things that are fending off a recession, like higher interest rates, are actually pushing us back down. When mortgage rates go up, people aren't moving. It means they're not buying more furniture. It means they're not redecorating at the same level. So what keeps the country out of a recession ultimately is good for us, but short term is probably makes it a little tougher.
It's really interesting to think about you guys being tied closely with the housing data that we cover as well. Thank you so much, Jonathan. Really, really appreciate your time joining us in studio today. Again, Overstock.com. If you load that up right now, you're going to see Bed Bath & Beyond on your screen. Really interesting talking with the CEO, Jonathan Johnson here. Thank you so much for that.
All right. You're listening to Bloomberg Business Week, and this is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
This is Bloomberg Business Week, and let's get a quick check of the markets. We haven't checked in on those in a while. The Dow up about 0.1%. The S&P 500 down 0.3%. The Nasdaq down 0.4%. Well, Maddie, the stock rally that's taken a little bit of a breather has, it's lost a little bit of steam in the last couple of days. I got to tell you, the S&P 500 up 19%. This year in August. It's nothing to shake a stick at. We did get a mixed bag of corporate earnings and economic data that's leaving markets a little bit meh today. But we got a great guest here to make sense of it all.
Yeah, I'm very excited about getting someone to help me make sense of all of the movement that we're seeing here. For our drive to the close, we've got Christopher Tsai on, President and CEO at Tsai Capital. Christopher, it's so great to speak with you, and thanks for coming in here. We're talking about the meh trade here today. What would you say is the single biggest thing kind of driving this trade? Is it investors sort of taking on some profits, and that's why we're seeing a little bit less green on the screen here, or is it kind of just a mixed reaction to the eco data?
I mean, we've had an incredible run this year in all of the major indexes, but what we try to do really at Tsai Capital is focus on the long term. So we really don't pay much attention to the everyday noise that is circling the markets.
Well, what would you consider everyday noise versus what you do pay attention to?
Well, we have now a 23-year track record, and we've gone through so many different environments with noise such as inflation concerns, recession concerns. We've navigated through the Asian financial crisis, the dot-com bubble, et cetera, et cetera. And there's never been really that much of great news to look at. So what we try to do is focus on the long term and focus on the individual fundamentals of the companies that we're investing in. And it's just to us nonsensical to forego investing in a business that has a predictable long-term future because of short-term concerns about the market or the economy that are inherently unpredictable.
So what does that calculation look like when it comes to the fundamentals?
Well, we think that the fundamentals for many companies are actually quite strong. And our focus is really to look at the strongest of the strong, to focus on the high quality businesses that we think have great futures, that are growing rapidly, and to take advantage of market weakness. Your previous guest spoke about coming out of this environment, playing offense, and we think about that kind of strategy as well. So in other words, when we have a bear market like we recently had, we've played a little offense. We added a number of companies to the portfolios that we think have great futures, that have asymmetry in the potential returns. So that's what we're trying to do, provide diversification for our investors, but also to provide some offense coming out of a recession.
What are some of those companies that you've recently added to?
Yes, we added to a company called MSCI, which is a leader in data analytics. It's a company that is really integral to many money management firms and financial service organizations. We also bought a company called Zoetis, which is a leading manufacturer of pharmaceuticals for the livestock and poultry industries.
I'm going to totally switch gears here, you guys. I hope that's okay. I'm realizing in your guest note that you talk about your grandmother, Ruth Tsai, was the first woman to trade shares on the floor of the Shanghai Stock Exchange. That is so cool. Do you have any investment lessons that have been passed down to you, both from her and from your father, of course, as well?
Yeah, that's a great question. I appreciate that question because my late father has been in the press so many times, but my grandmother, Ruth, was really a pioneer for women in China at her time. So as you mentioned, she was the first woman to trade on the floor of the Shanghai Stock Exchange from around 1939 to 1941. And she passed on so many wonderful lessons to my father, and my father passed on so many wonderful lessons to me. So I'm really a third generation investor. My grandmother Ruth had a saying, when the tide goes out 10 feet, a large ship and a small boat both go out 10 feet. I think that was her way of really thinking about bear markets and how to deal with bear markets.
I love that. Hey, just in the last 30 seconds that we have with you, if somebody brings new money to you right now and they have a long-term horizon, how are you deploying it?
That's also an amazing question because we always find that deploying capital is a lot harder than learning how to sell a company. So what we try to do is we try to scale into our scale in new capital. So we typically invest around 2/3 up front, and then we try to deploy the rest of the third in a relatively short period of time. What we're trying to get away from is timing the market. Clients come with us with a long-term philosophy, so we're not trying to time 1 month or 2 months, but we do like to scale in to a degree.
Christopher Tsai, President and CIO at Tsai Capital, joining us this afternoon on Zoom. Really appreciate you taking the time to join us right here on Bloomberg Business Week. And this is Bloomberg.
your company news headlines on Bloomberg Radio.
It's 3:53 on Wall Street. We are awaiting earnings after the bell from Starbucks, Advanced Micro Devices, and MicroStrategy. Overstock.com now operating as Bed Bath & Beyond in the United States. That word from CEO Jonathan Johnson, who was interviewed moments ago right here on Bloomberg Business Week, and he told us, yes, coupons will be a key part of the strategy.
So we are a promotion. We've always been a promotional company with site sales, with coupons. As we do this rebrand launch, the coupons are big. They're Bed Bath & Beyond-esque size.
Yeah.
Over time, they won't be that big always because our prices have been sharper.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Uber says it's developing an AI-powered chatbot to integrate into its app. CEO Dara Khosrowshahi spoke about AI during an interview this morning on Bloomberg Radio.
Don't forget about the driver. Drivers who are driving on our marketplace, they also want help. Where should I go? What ride should I accept, etc. So we're also working on AI to power drivers and couriers so that they can make smarter decisions every day to be able to earn flexibly, but to maximize their earnings based on their time.
And you can hear more of that conversation on the Bloomberg Technology Podcast. You can download it wherever you get your podcasts. Uber shares, they're down 5.9%. Rival Lyft down 3.9%. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Hey, it's Bloomberg Business Week. Tim Stenevec and Maddie Mills on this Tuesday afternoon, the first day of August. Maddie.
Tim.
There's a sort of a changing tune when it comes to how strategists are thinking about the S&P 500. We talked about it with Alex a little bit earlier in the program. But JP Morgan's trading desk says a record S&P 500, quote, feels inevitable. I saw that headline and I was thinking to myself, well, of course. I mean, the S&P 500 will one day hit a record again. You know, we just don't know when. But JP Morgan says that it's going to happen around September before climbing to an all-time high.
I love when stories like this come out and we see infighting at the firms, just because I like to picture them all arguing.
That makes a market, you know?
It makes the market. Obviously, this firm's strategist, Marko Kolanovic, is sticking to his bearish stance, has been sticking to the stance all year, but on Monday he did say stocks were pricing in, quote, an unrealistic outcome of continued economic expansion and imminent rate cuts by global central banks. So still seeing some disagreement there, but I agree with you, Tim. It's gonna hit another record eventually.
Eventually.
Yeah.
You just don't know when. It's like with all the recession talk, you know. The inverted yield curve predicts a recession. Well, of course, there will be a recession at some point. It's a normal part of an economic cycle. The question is, when does that happen?
Right.
All right, before we go and join our Bloomberg TV colleagues for our Beyond the Bell, I want to touch on this story about Meta Platforms. It has begun blocking news in Canada in response to a new law. It started its process of ending news availability in Canada over a law requiring digital platforms to pay local news outlets. Our own Bloomberg News team writing that Meta Platforms has followed through with its threat to block news on Facebook and Instagram. It comes after Prime Minister Justin Trudeau's government passed the Online News Act, expected to come into effect before the end of the year.
This is the problem, right? And this is why ultimately this failed in the U.S., at least according to some of the folks that we've spoken with, is that the response is not going to be for Meta to pay the news platforms for content. The response is going to be, okay, we just won't have news on Facebook, on Instagram, now on Threads. Interesting to think about the impact on Threads. I wonder whether we'll see any impact there.
Are you doing Threads?
I'm on it, but I don't use it. Are you?
Same. I mean, I think like there was a lot of excitement around it when it first came out. The question is, do the users stick, right? Engagement. Well, speaking of engagement, we're going to be joined by our friends at Bloomberg TV for Beyond the Bell. It's starting in just a few minutes. This is Bloomberg.
Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast, joined right now by, well, a very well-dressed Madison Mills and Tim Stenovic. Welcome to our audiences across Bloomberg Television, Radio, and Originals, and our partnership with YouTube.
I love the attention that I'm getting today.
Yeah.
Also a great reminder that I am fueling the consumer spending that this economy is racketing up on.
Someone's got to do it, Maddie.
Someone's got to do it. You know, guys, we just had the CEO of Bed Bath & Beyond on. If you go to overstock.com right now, guess what you see? Bed Bath & Beyond labels. Branding. So
Okay, I'm going to do that right now. Keep talking.
Talking about the return of the consumer, right, Tim?
Yeah, you know, I did ask him how he felt the consumer was, and he said I said, is the consumer strong right now? And he didn't quite answer that question. What he did was he actually said the consumer is looking for deals, and he's hopeful that we can avoid a recession because a recession would really affect his business. And he said he's been held back by people not moving because if they're not moving, then they're not actually buying new stuff.
So I just went to this website. So yeah, if you type in overstock.com, it goes to Bed Bath & Beyond. First thing, receive a 25% coupon, exclusive. 20% off this, 15% off that. I thought they were, what are they doing?
That was my exact question. Because as you know, I know you follow the Bloomberg Originals content very closely,
Absolutely.
Romaine.
I watch it every night.
I did the video called Bed Bath & Bankruptcy, and I said, how are you going to take that brand and not have the same fate, especially when you're relying on the same tools like the coupons? He said they're going to kind of pare that back over time. So TBD on what that's going to do to revenue.
Yeah, okay. Well, I mean, I felt like you could have started that way. But, okay, that's a whole nother conversation. We get the closing bells here in New York. The one bright spot on the day that belongs to the Dow Jones Industrial Average, higher by about 71 points or about 0.2%. Meanwhile, the rest of the major indices closing out the day in the red, with the S&P down about 0.3%, the NASDAQ Composite down about 0.4%, and the Russell 2000 looks like it's going to close out the day down about 9 points or 0.5%.
Well, I also want to mention Manchester United shares extending their drop to 8.8%. That is the most since May today in heavy trading there, hitting some session lows, more than 2.7 million shares traded on Tuesday. So still seeing that Manchester United story continuing there, Katie. And then when we look at the Fed commentary that we've been getting, Raphael Bostic, we do not see a rate cut until the second half of 2024 at the earliest. So just reading through some of those headlines here.
Well, let's dive below the indexes right now and take a look at some of the sectors. You can see that a lot of red on the screen, 9 of 11 in the red. What did do well is industrials. Of course, we know a lot of that coming from Caterpillar, and tech also hanging on there. You go down the list, there's a lot of losers. I'm talking about healthcare, consumer discretionary, and at the bottom, you do have some utilities. Utilities. And before we get to some of the individual gainers and losers, I do want to bring you some breaking news here. We do have earnings out from MicroStrategy. So second quarter digital assets, of course, this is closely watched, came in at $2.32 billion. Take a look at the analysts who still cover the stock. A lot of them point to the digital asset holdings. We're going to get some more detail on that. In terms of second quarter EPS, adjusted EPS came in at $2.35. The estimate had been for 67 cents, so really interesting there. You take a look at the shares after hours, currently down as we parse through some of these results.
All right, Katie, well, I'm going to go through a couple of the gainers while we wait for some other earnings to come in for the day. I want to start with Arista Networks going up as much as 17% today. This is the maker of computer networking gear. Its biggest customers are Microsoft, Meta. The earnings beat estimates leading to a pop there. Also, guys, this is one of those AI names to drop, so benefiting a little bit from that euphoria. Also want to go over to Caterpillar, ending the day up by almost 8.9% there. That is the most since that fateful month in all of our hearts, March 2020. Interesting because we're hearing about some manufacturing weakness when it comes to the eco data, but then you've got Caterpillar beating estimates. Guys, I don't know about you, but I can't go anywhere without seeing a ton of construction, so really seeing Bidenomics in work here when it comes to the Caterpillar story. And then we've got AMD. We're getting those earnings any minute now, but interesting to note that the question going into that call is whether they're going to be able to use some of their AI tools to create another AI success story for them, and still seeing that a lot of these semiconductor companies rather doing really well when it comes to earnings, Tim.
All right, you got the gainers, Maddie. I got the decliners. Let's talk Tesla. Shares finishing the day down by 2.4%. Fell today as investors learned that it's the subject of another probe by U.S. regulators. This time the probe focuses on driver complaints about vehicles possibly at risk of losing control of steering. Zebra Technologies, the worst performer on a percentage basis in the S&P 500. This is a company that makes barcode scanners, mobile kiosks, and the like, down 17% today. Shares at one point falling more than 20%. They gave a weak forecast, and shares falling the most since 2016 today. And then Norwegian Cruise Lines down 12%. I should note, Norwegian Cruise Lines shares have been on a tear before yesterday, up 80% year to date going into earnings. But the cruise line operator issued a third quarter guidance on adjusted earnings per share that missed consensus estimates.
Yeah, we could see a lot of market reactions like that given how far some of these stocks have rallied. And of course, if the fundamentals don't back it up, you're going to get those types of knee jerks. Let's take a quick check of what happened in the yield space here. Relatively muted on the day. The 2-year yield finishing the day slightly higher by about 2 basis points. And well, your outperformer, well, that was actually on the longer end of the curve here, underperformer, I should say here. Yields higher on your 30-year and your 20-year by about 8 basis points here. That is the macro, Katie. The micro is still in focus, though.
Micro's still in focus, and we are getting some earnings out of Caesars Entertainment as well. It looks like those numbers coming in. Second quarter net revenue came in at $2.88 billion. The estimate had been for $2.86 billion, so pretty much on the screws there. Second quarter EPS, $4.26, Tim.
This is Caesars. This is the casino, not the salad company.
Yes.
I do look to, though, I am interested to hear about gaming right now and to what extent it can tell us a story about the American consumer. It can tell a story about the global consumer when we do hear from those gaming companies around the world, Romaine, and to what extent they're actually traveling and spending money on something like this.
Yeah, and actually, I like this part of the earnings season because I feel like you get a much bigger cross-section of companies here, and you get a better sense here of what people are actually buying. Getting Starbucks earnings crossing the wire right now. Your main headline here for the fiscal third quarter is that comp sales, they're coming in at about 10%. That's slightly below what the street was looking for. The street was looking for comp sales growth of 11.1%. They only got 10 here. As far as revenue, dollar value, coming in at $9.2 billion. That's on the nose for what the street was expecting. Let's take a look at China real quickly. Those sales, at least on a growth basis, were better than what the street was expecting. 46% growth in China versus estimates of about 42% here. Not quite seeing a forecast just yet here, but the overall picture appears to be overall a slight miss on comp sales, but somewhat of a beat here in some of their international markets.
Yeah, that's a bit in line with what analysts were expecting, looking for a little bit of a mixed report from the Starbucks story. But I talked to an investor earlier today who said that the biggest question for Starbucks was going to be that performance in China. So as you mentioned, Romaine, if they are having a little bit of a beat when it comes to the China story, that's not only a big deal for Starbucks, Tim, but that's also a big deal for some of these other companies as well.
Yeah, also the question with Starbucks that a lot of analysts will be asking later on the call is any update on what's going on with labor around the country. It's a U.S.-focused story, certainly, and international when it comes to Starbucks is huge, but the story here in the U.S. still continues to be labor.
I also really quickly want to point out Pinterest reporting adjusted earnings per share for the second quarter that did beat the average analyst estimate. We're getting adjusted EPS of 21 cents. The estimate was 11 cents. Also beat on revenue coming in at $708 million, the estimate of $699 million there. U.S. and Canada active users of 95 million, the estimate was 94. So a little bit of a beat, not a huge beat there. Not seeing a huge movement when it comes to the trade. Actually, they're up by a little over 2% at the moment. So seeing a little bit of a pop on those earnings when it comes to the Pinterest trade today. The big question for them is going to be whether or not their advertising numbers are going to be able to maintain some of the growth that we've seen from the likes of Meta. We saw a loss on that, though, when it came to Snap's story this year.
All right, you're talking Pinterest. I'm looking at EA right now. The company coming out with net bookings that missed forecasts that missed estimates. The second quarter adjusted EPS also coming in below estimates. That came in at $1.10 to $1.30. Shares down in the after hours, Katie, right now by 4.5%. This was set to be a huge quarter for the company. The new Star Wars Jedi game, analysts are really bullish on it.
And you can see that disappointment again in the shares, 4.5%. It's worth noting that EA for the year was only up about 11.4%. Of course, still double digits, but definitely lagging the market. And you can see, again, those high expectations didn't exactly deliver.
All right, lots of news when it comes to the earnings story there, from Starbucks to Pinterest. We're going to continue to cover all of it right here for you. But guys, that does leave us off of our coverage for today. Thank you so much for having us, Romaine and Katie. Tim and I will continue on Bloomberg Business Week Radio. We're going to be back tomorrow, same time, same place.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Those earnings coming fast and furious.
They always do, Tim.
They always do. We're going to keep bringing you the latest with the numbers as they continue to cross. Taking a look at Starbucks right now, shares down in the after hours. But the company's CEO said the strong third quarter results point to an all-around momentum in the business and reflect the significant progress we're making against our reinvention plan. Well, let's switch gears a little bit and talk about the most read feature on the Bloomberg terminal today. The boss at Apollo has left the 43rd floor for a windowless post down on 9. He favors sweaters over suits, eats in the cafeteria. He talks about diversity, thinks about philanthropy. His reserved, methodical way of doing business has led people to call him the professor. Sometimes the writing, I would say oftentimes the writing is so good from our colleagues that instead of writing my own intro, I just read their stories. And indeed, that's the case. So writes Allison McNeely, distressed debt reporter, in a wonderful piece about how Mark Rowan is trying to change things at Apollo. It's today's most read feature on the Bloomberg terminal. She joins us here in our Bloomberg Interactive Brokers studio. Really good to have you with us, Allison. Congratulations on the piece. What was Apollo before Mark Rowan?
Well, first of all, thank you for having me. So Apollo has long had a reputation in financial markets as being possibly the most aggressive private equity investor. And particularly, they built their name on sort of really aggressive transactions, really aggressive maneuvers around distressed companies and in bankruptcy court. And that legacy and that sort of image was really built up over the past 30 years, particularly under the leadership of former CEO Leon Black, who, of course, departed in 2021 amid, sort of a real uproar over his ties to Jeffrey Epstein.
And in the story, you call that the Wall Street version of Game of Thrones. Can you tell me a little bit more about what that looked like?
Sure. Well, it was really an extremely difficult time for Apollo, essentially. These payments to Jeffrey Epstein made by Leon Black came out in the press at the time. There was a sort of an investigation, and what the investigation found was that Apollo was not aware of these sort of payments, that there was no sort of connection to the firm. But essentially, the uproar was so significant that really, Leon Black, I guess, could not stay in that role, or they felt that he could not stay in the role, and so it sort of became like a phasing out, and eventually, Mark Rowan came in as CEO in March 2021.
So let's fast forward to, August 2023, and the transformation that at least Mark Rowan is trying to do at Apollo. Is this where's this desire to transform the company coming from? Is it coming from LPs? Is it coming from attracting and retaining talent? Because we're talking private equity here.
Totally.
It's not warm and fuzzy. He's not a kindergarten teacher. These are the people who are the barbarians at the gate.
Sure, yeah. So I think it's coming from a bunch of different places. So there's sort of two prongs to the Apollo story. The first is the cultural piece. We've touched on it, the Jeffrey Epstein piece. Apollo was really caught up in a reckoning over working conditions on Wall Street that we saw during the pandemic, really, really long hours, and, just a really tough place to work, kind of the place where someone described it to me in the course of reporting the story as the kind of place where you have to put on your armor before you go to work, you have to suit up for battle kind of place. And so that there was kind of that aspect. And to be clear, this was considered unique among private equity firms because, as you know, private equity is not exactly the most warm and fuzzy place, but this was sort of uniquely tough. So there was that piece, and that was kind of tied with the Jeffrey Epstein news. That was kind of creating some real noise around the firm, making it harder to, sort of attract talent, that kind of thing. And then there was also the second piece around the investing strategy. And long story short, Apollo built up such a difficult reputation, or a reputation for being difficult rather, that essentially it started to cost them money. And when they were trying to finance their buyouts in the leveraged loan market and the bond market, they were sort of getting what people call the Apollo premium, which is essentially being charged 50 to 100 basis points of additional interest compared to, say, a comparable deal, in order to essentially be compensated for the trouble of lending the money.
Wow. Okay, so once it started to hurt their bottom line, was that the moment of like, maybe we should change our culture?
Sure. And exactly. And then the other piece here that's really important is the Athene angle, the insurance angle. So Mark Rowan's baby, quote unquote, is the Athene insurance unit at Apollo. And essentially that is an entity within the firm that writes annuity policies for retirees. And Mark Rowan identified way back in 2009 that there was a really interesting investing opportunity to be had, essentially collecting the cash on annuities, investing that in a variety of credit investments, and then paying out to retirees, and essentially becoming like sort of the middleman or the investment manager for insurers. And so really, since he took over as CEO, he took the opportunity to expand into that business, because he's been on record about this repeatedly, saying, he feels that that's a much more attractive growth opportunity for the firm as it looks towards the future.
But is that a result of the end of zero interest rate policy? Because this comes at a time when private equity is having to deal with interest rates that are higher than at almost any other point in their history for some of these companies.
Yes. So the backdrop of, interest rates not being zero for the first time in, I guess, more than a decade is definitely a factor here. And that actually makes it very lucrative to be in the lending business right now. If previously you were, fighting to get any interest you could, and now you can get, I guess, a minimum of 5.5%.
So it all raises the question, should we even call Apollo a private equity firm?
They would say no.
Okay. What would you say? They would say, as you write in the piece, right, an alternative asset manager?
Yeah.
What would you say?
So that is, I do think that's fair. I think you can call them both. I think you can call them a private equity firm, but I do think it's also fair to call them an alternative asset manager, because 80% of their assets under management are now credit or credit-like assets. Their assets under management are just shy of $600 billion. Only $100 billion of that is private equity.
How much of that changed after March and what we saw with some of the banking turmoil, or has that been the case for a while?
That has been the case for a while.
Yeah.
It's been sort of this ongoing shift. And essentially, but to your point, the banking crisis is definitely presenting lots of opportunities for firms like Apollo, because they can sort of step in where the banks have stepped back or are being forced to step back. And so, they've identified that as a growth area for them.
Okay, so he's no longer on the 43rd floor. He's wearing sweaters. He's not wearing suits. He's eating amongst the regular people.
The sweater
in the
thing,
cafeteria.
I'm sorry, the way I cackled reading the sweater as the indicator that someone is in touch with their employees, that was so funny. Yeah, go ahead.
Well, Maddie raises the exact point that I wanted to ask you, Allison. Is it working? Is it changing the culture? Is it changing the view of Apollo?
You know what? I think they have made progress. I think there's some genuine progress there. The impression that I got talking to people in the market, talking to current and former employees, was that yes, there's people do think that Mark Rowan, the CEO, is moving the firm in a better direction. The sense I also get is that it's still very much a work in progress, but he generally gets favorable reviews.
Are people still suiting up their armor to go to work?
I think some people still are.
It's hard to shift a culture.
It is.
At a huge company.
Yeah, in 2 years. It's extremely difficult.
Yeah.
And I guess the last thing I'd ask you is just about attracting and retaining talent, and to what extent this shift has to do with that. I know at the beginning you said it's sort of about everything, but with all the departures that we saw, and we only have about 30 seconds left, over the last few years it's been tough. The jobs market is not as tough now, but it's been tough to attract and retain people.
Yeah, it has been. But private equity, or alternative asset managers, if you will, are actually in a really good point or position right now relative to the banks. Banks are being forced to lay people off. alternative asset managers are actually adding people, or at least holding on to people, because, you know, everything that's going on with the banking crisis, interest rates, uncertain U.S. economy creates opportunities for opportunistic investors, which is really what private equity is.
Well, it's a great feature. I've said it a few times. You've got to go read it. It's available on the Bloomberg Terminal. It's the most read on the Bloomberg Terminal today. The story by Allison McNeely, distressed debt reporter. She joined us here in the Bloomberg Interactive Brokers studio. Allison, thanks for taking the time. Really appreciate it. You're listening to Bloomberg Business Week, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. Headlines crossing the Bloomberg Professional Service right now out of Advanced Micro Devices. Shares up 2.9%. AMD sees third quarter revenue in the range of $5.4 billion to $6 billion. Estimates have been for $5.84 billion, but after hours, shares of AMD, they are trading higher now by just about 2.9%. Starbucks quarterly sales fell short of analyst estimates, a sign that momentum may be slowing for the coffee giant amid higher prices and tighter pocketbooks. MicroStrategy reported revenue for the second quarter that did miss the average analyst estimates. After ours, we do have MicroStrategy down by just about 0.7%. A mixed Tuesday on Wall Street. We had the Dow higher by 71 points, up by about 0.2%. S&P 500 index down 12, drop there of 0.3%. NASDAQ lower by 62, a decline of 0.4%. 10-year yield 4.03%, with a 2-year that's yielding 4.90%. Spot gold at $19.44 the ounce. Spot gold down 1.1% today, and West Texas Intermediate crude at 81.66 a barrel, drop there of just about 0.2%. So again, recapping, mixed day on Wall Street here. We've got the Dow up 0.2%. The S&P was down 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Really do appreciate it. Well, lots happening in the world of EVs today. Shares of Tesla finishing the day down more than 2%. This as investors learned it's the subject of yet another probe by U.S. regulators. This time it's focusing on driver complaints about vehicles possibly at risk of losing control of steering. BMW slumping today, warned of higher expenses for developing EVs. And then Ford also restarted production of its F-150 Lightning pickup. That is, of course, the electric version of the F-150. It's betting that those price cuts are going to spark some demand for those EVs among a broader group of U.S. drivers. Joining us now for all things EVs, we've got Bloomberg Plugged In. It's our weekly look at all things EVs. And we've got Bloomberg Technology co-host Ed Ludlow joining us from our San Francisco studio.
The one and only.
I know Tesla, because this is just the latest in a series of investigations. We've got seatbelts, steering wheels, driver assistance features. What's going on?
So it's really common for regulators to investigate car makers. And I make that point first because it's just the latest example of how in the investors, Tesla owners, fans, whether it's a car company or a technology company. So the details are that NHTSA, the National Highway Traffic and Safety Administration, is looking at around 280,000 Model 3 and Ys because they got 12 driver complaints about the vehicle possibly losing control of steering. In one of the complaints, there was a crash that involved a fire. In none of the complaints and none of the incidents was anyone hurt, injured, or worse. So, you're completely right. The latest regulator check, but these are kind of commonplace. And the stock was down around 2% today, but it's up 111% year to date. Had a great week last week. So I think this is just a casual relationship rather than a causal one.
Yeah, it's a great point. And I wonder too, Ed, is this latest probe, is this about driverless technology, or is this about, just losing control while somebody's actually holding onto the steering wheel?
This is old-fashioned mechanical defect rather than a software fix. But you raise a good point that one of the criticisms that Tesla fans, Tesla owners, and indeed the company themselves have is that when the regulators put in place a, quote, recall, much of the time it is an issue that can be fixed with an over-the-air software update, historically, rather than a recall where tens of thousands or hundreds of thousands of units have to go to the mechanic, or to the shop to be fixed. In this case, I think they're looking at a mechanical defect.
But in terms of the trade for Tesla, something like this, it doesn't really move the needle, right?
It doesn't tend to, no.
Yeah.
I mean, last week was a good week for the stock. It down more than 2% today. Again, more than 110% gain year to date.
Right.
And, the first 6 months of this year, the stock really traded on this idea that actually price cuts really worked for the company. They'll continue to grow, and investors kind of believe in the story that Elon Musk paints, which is they're not so worried about being profitable if it means protecting their global growth footprint.
It's amazing, Ed. I know you saw this. We had this great series at Bloomberg News last week that surveyed Tesla owners.
Yes.
Follow up to something that we did originally in 2019, when the Model 3 first came out. And Tesla owners absolutely love their Teslas.
Oh,
and they will, if they're buying another EV, they will buy another Tesla. It's incredible. I thought with so much more competition out there, then these other companies would actually, really compete with the company.
So what's so interesting about that survey, check it out on Bloomberg.com, is that verbatim, the questions that we posed this time around were exactly the same as those we posed in 2019, with a very similar group, but expanded group of Model 3 owners. And, you know, they love the car. This has never been a problem for Tesla. You know, when they get people into it, those customers have tended to be delighted with the technology. What's different in our latest survey is that those same owners have their opinion of Elon Musk himself has soured, which is interesting, you know, separating the man from the broader company and its products.
But it's not like that makes them buy different cars.
Right.
That's what surprised me.
Yeah, you know, it's a two-way street as well. You know, it's why the Ford F-150 Lightning is such an interesting case study.
Well, let's talk about that.
Well, just as a broad principle or idea, in America, the pickup is king, right? You know, it's the sacred vehicle. And what we see is that actually in that class of vehicle, people are incredibly brand loyal. They drive F-150s because their parents drove F-150s and their grandparents drove F-150s, so on and so forth. The question is, though, that there hasn't really been a battery electric pickup on the market until Rivian came along, which was a new entrant, and then F-150 Lightning really got off the ground. So the question is, if people were driving an EV that was a Model 3 sedan, if you follow my logic, but really they wanted a pickup truck, do they jump back to Ford and F-150 Lightning in the long term? That's the story that I find so fascinating.
But there was also excitement from this survey for the Cybertruck.
Yes, the Cybertruck, which has been, you know, kind of on a timeline, much delayed from what was originally outset.
I mean, it's generous to even call it a timeline because it hasn't
It is a bit
at
generous.
all.
I mean, I remember being there in 2019, you know, when Elon Musk's on stage and they throw the glass ball against the window and it smashes.
Oops.
But, you know, exactly. But the you know, the deposit book or the demand picture seems really strong for that. And again, you know, the excitement and enthusiasm for Tesla products has not been a problem. It's not been unwavering. The difference with Cybertruck is that it's probably not going to come in at the lower price point that they had originally outlined, because it's proved much more expensive to manufacture.
So how cheap does Ford have to make their EV to gain market share from Tesla?
Yeah, I mean, broadly, that was the domino effect, right? Tesla used price cuts as a lever multiple times at the end of last year and beginning of this year, and Ford followed suit. They're now ramping up their production volumes. They'll have a run rate of 150,000 units for Lightning as of the third quarter. Mustang Mach-E has come back online and ramped production after some downtime on those lines. Price cuts do unlock pockets of demand. But the other side of the story is same for BMW. Ford's EV losses are now deepening. $4.5 billion for this year instead of the $3 billion they previously said. Because the idea is that, you know, when you introduce an EV to the market, you want to sell your most expensive version of it first and then lower the cost downwards. But if you're doing price cuts regularly and in response to a market condition, that obviously impacts your profitability as well.
Well, another revenue stream, as you know very well, is the truck chargers, Ed. Is there a point where Tesla is getting more revenue from chargers than from EVs?
Yeah, look, after the other domino effect of Tesla opening up the NACS network to its competitors happened, GM, Ford first, then GM, Rivian, a lot of sell-side analysts came out with a range of estimates of what it can mean for revenues going forward. You know, it's always been a kind of untapped source of revenue energy, pardon the pun, you know, for them. But it's how, you know, my understanding from sources is that in each of those agreements, no money changed hands between the parties. And the idea is that Tesla is not charging upfront those other OEMs for access to the network. They'll simply make money from it by a customer plugging in and being charged for the electricity, literally. And that's not a huge moneymaker in and of itself, unless you're at huge scale. But Tesla's advantage is the scale of its charging network, at least here in North America.
All right, Ed, in our final minute, I have a really important question for you. What is this GIF that you tweeted at me and Tim? And do I need to know about it to be cool?
Okay, so I love tech, I love earnings season, but I've just started playing Witcher 3, The Wild Hunt on PlayStation 5, and I'm loving it. You know, video games are just they're everything, at the moment. And the Netflix series is running in parallel. So, I work long days here at Bloomberg Technology, but I do enjoy playing a bit of video games when I eventually get home.
Yeah, well, I mean, it's a market indicator, Ed. This can totally work into your coverage here. So I appreciate it. Thanks for telling me that. That'll make me sound cool when I talk to boys about video games.
So that's your favorite game right now, Ed?
Well, it's just what I'm playing right now, and it's so story driven, and I'm loving having watched the TV series first. I've returned to the video games after many years away, so that's just what I'm up to.
All right, it's how Ed Ludlow, who does our plugged in segment, it's how he unplugs, how he unwinds. Bloomberg Technology Coast, Ed Ludlow. We love it when you join us, Ed. Thanks so much for taking the time. Really do appreciate it. Let's go to Washington, D.C. now for checking the latest world and national news with Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nancy.
Thanks, Tim. Rex Heuermann, accused of killing at least 3 women and burying their remains on New York's Gilgo Beach, was back in court today. His attorney says Heuermann still maintains his innocence. Investigators have spent the past 2 weeks poring over evidence in the case at his Long Island home. District Attorney Ray Tierney says it'll take some time to draw conclusions from what they found.
You wait until all the facts are in, and then you draw conclusions from those facts. So we still have to continue to wait for all of that, and not only the cataloging of the evidence, but all of the testing, including forensic testing, to get done, which unfortunately, unlike sometimes on TV, it just doesn't happen overnight.
That's Suffolk County DA Ray Tierney. Heuermann's attorney says his team was provided with 8 terabytes of information that will be reviewed over the coming months. The next court date is September 27th. Well, just a day after learning she'd been hospitalized, New Jersey officials say Lieutenant Governor Sheila Oliver has died. She was 71. She'd been serving as acting governor while Governor Phil Murphy was in Italy on vacation with his family. No cause of death has been given. Oliver had served in the Assembly and became Assembly Speaker in 2010. Murphy said when he selected Oliver as his running mate in 2017, quote, "I knew then that her decades of public service made her the ideal partner for me to lead the state of New Jersey. It was the best decision I ever made." Team USA will be advancing at the Women's World Cup, but just barely. The team had a scoreless tie overnight against Portugal, and fan Sabrina Justin from Colorado says she was nervous watching.
Oh, man, it was a clincher. I was really hoping that they were going to, get it at the end, but it wasn't quite there.
Sweden is expected to be Team USA's first opponent on Sunday in the knockout round. Global news 24 hours a day, powered by more than 2,700 journalists and analysts.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Advanced Micro Devices, among the names reporting earnings after the close of trading. It is the second largest maker of PC processors. Shares are gaining up 4.2% after hours, after the company topped second quarter estimates and said it is making further inroads into AI computing. Starbucks, lower after hours, down by about 0.8%. Quarterly sales did fall short of analyst estimates. And MicroStrategy, the enterprise software maker that is the largest publicly traded holder of Bitcoin, returned to profitability in the second quarter after having to take a large write-down a year earlier because of a plunge in the value of cryptocurrency. MicroStrategy after hours down by about 1.4%. Turned out to be a mixed day on Wall Street today. We did have the S&P 500 index falling 12 points, down by about 0.3%. The Dow up 71, up 0.2. NASDAQ down 62, a drop there of 0.4%. 10-year yield 4.03%. with a 2-year 4.90%. Spot gold down $20 the ounce to $19.44, a decline of 1%. West Texas Intermediate crude up 0.5%. WTI at 82.19 a barrel. Bottom line, mixed day for the Dow, the S&P, and NASDAQ. Again, recapping, S&P fell 12, down by about 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie, as always. Tim, I don't know about you, but I feel like disaster has been everywhere
Apocalyptic.
the past couple years, right?
Yeah. No, it really has.
Global pandemic, wildfires, Russian invasion of Ukraine. It's all over the place. And our next guest, disaster preparedness, and he joins us now to discuss the product and, of course, the AI space, because we got to talk about that. Phil, great to speak with you. Phil Siebel joining us on Zoom here, Siegel rather, the founder of CAPTOR, Center for Advanced Preparedness and Threat Response Simulation. Phil, thanks again for coming on. Start by just telling us a little bit about what your AI does.
So what we are is the intersection of artificial intelligence and gaming, wargaming. The basic idea is to better prepare, we need to create a set of threats that are plausible, some of which we've experienced, some of which we haven't experienced, and then run them through simulation games to train our crisis management personnel, and our politicians and decision makers to make better decisions. And I think, we could say, with a lot of the types of crises we've had over the last several years, maybe we have a fair amount of room for improvement. We use artificial intelligence both to generate these scenarios and also to help the quote-unquote players in the game make better decisions.
What are some of the games that you've simulated?
Yeah, so we've done, we created a new virus and ran a game with the Rockefeller Foundation.
Like a real virus, not a computer virus. We're talking like an actual, COVID-like virus?
Yes. Yes, it wasn't COVID-like. It had a very different characteristic. It came from livestock in the U.S., which is actually quite common, but it had very different characteristics. And we asked scientists to figure out what was going on and whether or not it was going to be a high, medium, or low threat to a regional population. We've created a game actually for City of Austin emergency management personnel to see how well the different departments that are supposed to respond to a threat like this would respond. And we're building games right now for scientists who are members of a group at the New York Academy of Sciences. So we're building a lot of games. We're using artificial intelligence to, really come up with some creative scenarios, but plausible scenarios. And that's, what we're seeing is that with more practice, just like pilots with a flight simulator, people do a better job when they practice.
All right, so obviously you are part of the AI bucket that we have become obsessed with in the first half of this year. So I do want to get your take on the space while we have you, because it's seen so much attention, and I have to wonder if the fundamentals back up some of the prices that we've seen for these big names like the NVIDIAs of the world. What is your calculation and your thinking when it comes to the AI rally that we've seen, and which of these names are going to continue to make it?
Yeah. So in my day job, I'm a private equity manager. So I think that the old adage of picks and shovels kind of win in the early days is probably fairly true here. I think that I don't know whether you would say NVIDIA is overpriced, but I would say that having it run up, given it's the by far leader in the chip space, which is the ultimate pick and shovel. There's other products like that, or there's other pieces like their supply chain. You've seen a lot of run up in those stocks as well, and we know those are going to benefit from what we're doing. Once you get past that, it gets a little murkier. I don't think we yet know whether the producers of the large language models, the ones that have made the big splash, are going to have viable business models yet. We haven't seen that. In fact, it's not clear to me whether the large language model makers are going to be the winners, or people who are experts at helping companies do small language models are going to be the winners in the space. So there's still a lot of uncertainty and cloudiness, I think, for the next several years.
Well, Phil, as you mentioned, your day job is in private equity. You've been an investor in private companies, venture-backed companies. You've been a professor. You were at BCG as a managing director and partner for many years. Where does your passion for AI come from, and for trying to create an organization that helps with disaster preparedness?
Yeah, so I volunteered during the pandemic to work with BCG on helping some of their government clients respond to the COVID emergency, and saw through that work that we have a lot of opportunity to practice. Again, I kind of thought about the analogy of when you get on an airplane, if you heard that your pilot hadn't been in a flight simulator, you'd be pretty alarmed. Yet, with a lot of our disaster preparedness and crisis management, we aren't doing that type of work every year. We do, obviously this group of people is highly educated and hardworking, but I would like to see them every year spending time honing their skills so that they're more ready and better. And that was really what caused me to want to co-found this NGO, if you will, or nonprofit.
Well, where does the AI come from? And are you at all concerned about AI in the sense of it being a threat to humanity?
Yeah, well, that's two very different questions. So I'll focus on the second. I'm less worried about the scenarios we see in the movies like iRobot or Terminator 2, where the AI becomes sentient and on its own decides it's going to destroy humanity. I am very worried that bad actors are going to use these technologies and are already using these technologies to do bad acts. Yeah. And that's what we need to be protecting against in the short term.
Yeah. 30 seconds, Phil. Who are some of the companies and names that should not be jumping on AI and investing heavily into the AI space?
Yeah, it's a good question, and I'm not 100% sure how to answer it, other than to say I think there are some sectors where they really need to be thinking about, especially capital-intensive sectors, where if they change the basic business model through investing in AI, they can lower the barriers to entry. They might have new entrants come in, whether it's the mining and exploration industry and so forth. You don't want to bring in new entrants that you don't have to. But on the other hand, you need to lower your operating costs. And so it's a race.
And it's all about capital allocation at the end of the day. Phil, thank you so much for joining us. We're going to have to bring you back on. Phil Siegel, founder of Captors, that's the Center for Advanced Preparedness and Threat Response Simulation, among many other resume lines.
And before we get to the break, we do want to bring you a redhead. President Trump says he expects to be indicted today by special counsel.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story repeating an earlier headline. Former President Donald Trump says he does expect to be indicted today by special counsel. Trump says he expects to be indicted at 5 p.m. Wall Street time. Stay with Bloomberg for the very latest on this developing story. Earnings news. Advanced Micro Devices, the second largest maker of PC processors, is gaining after the company topped second quarter estimates and said it is making further inroads in artificial intelligence computing. Now, after ours, AMD shares up by 4%. MicroStrategy, the enterprise software maker that is the largest publicly traded holder of Bitcoin, returned to profitability in the second quarter. CVS Health shares down today by 1%. CVS cutting 5,000 positions from its workforce to help reduce costs. And with that story, here's Bloomberg's Courtney Donahoe.
Charlie, the drugstore chain is focused on broadening from its retail roots into more healthcare offerings. A spokesperson says none of the job losses will impact customer-facing positions in stores, pharmacies, clinics, or customer service centers. CVS has been taking steps to move deeply into patient care, including the recent acquisitions of home health care provider Signify Health and primary care company Oak Street Health. Rival Walgreens has also been cutting jobs on a similar move to diversify away from drugstore operations. Charlie?
And that's Courtney Donahoe reporting after earnings today. Caterpillar up 8.9%. And those are some of our top company stories at this hour. And this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. Tim Stenivek and Maddie Mills. Let's get a check on the latest world and national news with Nancy Lyons. She's in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Members of the grand jury hearing evidence in special counsel Jack Smith's probe of 2020 election interference have left a federal courthouse where they had been meeting today. Former President Trump says in a post he expects a, quote, fake indictment at 5 p.m. Eastern Time. That's just in a few minutes. Rebecca Roife, though, is a law professor at New York Law School.
I think it's anyone's guess in terms of the timing. It does seem imminent, but again, there's just so much wiggle room around the procedures at this point that it's not entirely clear whether it would be today or another day this week, potentially even, could take a couple of days more than that, depending on all sorts of factors that we just don't know.
Professor Roife spoke with Bloomberg. The family of Henrietta Lacks is agreeing to settle a lawsuit against a biotech company that it accused of improperly profiting from her cells. They claimed Thermo Fisher Scientific had made billions from tissue taken without consent from Lack's cervical cancer tumor. HeLa cells, as they're called, were the first human cells to be successfully cloned and have been infinitely reproduced, becoming a cornerstone of modern medicine. Lawrence Lacks is her grandson.
My grandmother gave the world a gift 70 years ago. And we're here today to give her a gift of justice. Yeah!
Terms of the settlement are confidential. New Jersey Lieutenant Governor Sheila Oliver has died. That's according to a statement released by the governor's office. She'd been filling in for Governor Phil Murphy while he has been on a European vacation. And just yesterday, Murphy's office released a statement saying Oliver had been hospitalized with an undisclosed medical condition. The New York Mets have reportedly traded pitcher Justin Verlander to the Houston Astros. The 40-year-old Verlander won his third Cy Young Award and second World Series with Houston last season. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Tim and Madison.
Thank you so much for that update, Nancy Lyons. Really do appreciate it. I want to repeat a headline that we did just hear, that President Trump says that he expects to be indicted today by a special counsel. We'll bring you that news live if it does indeed end up happening. In the meantime, Maddie, I want to talk a little bit about subway fares.
Oh, yeah.
I had a terrible subway ride this morning.
Oh, no. What happened?
There was a signal malfunction, so I was stuck underground for a while. Late to a meeting, and I got very frustrated and thought, you know what? If the state wants people to come back to work,
I know.
The city wants people to come back to work, then let's get the subways more reliable.
This is what I always think about, because now it's going to be $2.90, right? I'm just going to say $3.
Yeah, fine.
Yeah.
Fix it, though.
But also, one, fix it. Two, You want people to pay $6 a day round trip to go into the office? That's not going to happen. People don't want to pay to go to work.
I don't know if Charlie Pellet is still in here because he's the voice of the New York City subways. He's not still in here. I'm not going to look behind me because I'm going to. But I would push back on that and say I still think it's a really good deal when it comes to commuting.
Yeah.
And I also think that it ends up being so much cheaper than owning a car, no matter where you live.
Of course, yeah.
My friends who live in other parts of the country who have to drive into the office, although nobody does because nobody has to go to work.
Right.
You
Well,
know,
that's the thing. It's not that I think it's expensive. It's that I think people want to pay $0 to go to work.
I think you're absolutely
by never
right.
going.
And, given the number of people I saw who were just hanging out in Brooklyn every single day, Monday through Friday, when I was on leave, I was thinking to myself, am I the only one who goes to an office?
Right.
It's sometimes what it feels like.
Would you see people like working in cafes?
A lot of people working in cafes, but a lot of people just not working also.
Yeah.
Yeah.
Like, what were they doing? They're just like outside.
They're just out hanging out. What do you make of the, look, it's